Good afternoon. Today we're going to continue with Chapter 8. We're going to talk about independence and the role of independence in client acceptance. Here's our definition of objectivity and independence. We use this for our definition of independence. Members should maintain objectivity and be free of conflicts of interest in discharging professional responsibilities. All members. A member of the AICPA in public practice should be independent in fact and appearance when providing audit services. Think about what we know about independence, about covered members, about professional employees, and we have to put that together while we're looking at new clients. I've tried to formulate this into a meaningful question, and I can't do it. When a firm goes out to bid for a new client, they need to inform who? Partners in the engagement office, everyone in the engagement office, everyone in the firm, consulting and tax employees, or just auditors? Do we need to consider immediate family? So the short answer is I think most of the firms, some of you had internships. If they went out to bid for anything, you had to fill out an independence memo, I believe. So basically the firms are going to send it out to virtually everybody in the firm. You can see how difficult this becomes to manage. Well, we know the partners in the engagement office, but we don't know who's going to be on the audit just yet. We don't know who in the Miami office might own stock in that company. We don't know just how much consulting and tax work we might end up doing for this client. So most firms' standards for independence exceed the AICPA standards. They do that in order to make it practical to implement. It will be very, very difficult for a large firm to implement the standards. So rather than try to implement the standards, they create blanket standards that are more restrictive than the ICPA's. So when you go to work for a big accounting firm, don't think that their understanding of independence is incorrect. It's not. But in order to make it practical and to ease their implementation, they all have standards that are much more rigorous than the ICPA's. Let's think about close relatives and financial investments. We all remember that if a close relative has a material financial interest, that becomes a material indirect financial interest to us, and that will impair independence. So we have to consider the financial interest of our close relatives, at least the ones of which we're aware. Again, close relatives employed by a client. And this is not just close relatives. This would be immediate family or close relatives. If an immediate family or close relative has a key position with a client, that will impair independence. Immediate family and close relatives are not prohibited from working for a client, but they can't have a key position. So what's a key position? Now, the standard says covered members, and it's really not quite covered members, but I'd simplify it in my mind. It's covered members. Close relatives can't hold a key position with a client. Now, the number 2 and 3, I'm not going to worry about. Hold a financial interest in the client that is material to the relative. Well, we know that, right? We already covered that. The close relative that has a financial interest in a client, that's an indirect financial interest for us. And if it's a material to the close relative, that's a material indirect financial interest, and it will impair independence. The last one, holding a financial interest that enables the relative to exercise significant influence over the client. Well, that doesn't bother me, because for anybody I know, if they had a financial interest that enabled them to exercise significant influence over the client, it would be material to them. That's not always true, but for everybody I know, it is. So it's possible for Warren Buffett to have an interest in a small company that allows him to exercise significant influence, but is not material to him. What I'm really worried about here is what's a key position with the client. These are always key positions. Somebody on the board of directors, the CEO, the chief anything officer, chief financial officer, chief marketing officer, chief information officer, any of the chiefs have the ear of the CEO. And so any of the chiefs, we've got to assume, can exercise influence over the reporting process. The general counsel, and then we've got our financial people, controller, director of internal audit, director of financial reporting, treasurer. Those people are always key positions. Now, as we get further away from those top management positions, and if an individual has primary responsible for a significant accounting function that supports material components of the financial statements. So could they be a warehouse manager? Probably. Could they be in charge of inventory accounting? Probably not. Okay. So anybody that is a role in supports a significant component of the financial statements, that would be a key position. Anybody involved in the preparation of the financial statements, that would be a key position. How are we going to know about that? Well, if a position's a key position, that position is probably subject to internal controls. Or that position may be an element of the internal controls. So we should be able to identify these key positions as we obtain an understanding of the client's internal controls. Remember, 315 tells us we're required to obtain an understanding of the entity, its environment, including its internal controls. So we're required to obtain an understanding of the internal controls. And as part of that, we should be able to identify the key positions and make sure they're not held by immediate family or close relatives of covered members. Thank you. The next lecture, we'll talk about risk.